Dear Professor Kuhn and fellow students, welcome. I'm Chengzhuo Zhang. Today I will discuss FAST ASC topic 480 using a practical business case study to explain the new rules in ASU June 2020 regarding the distinction between liabilities and equity, as well as the profound impact of this change on corporate financial reporting. We will systematically examine this topic, covering its overview, deferred tax analysis, and final impact assessment. Now, let's begin today's discussion. This presentation consists of three interconnected progressive sections. First, FAST ASC topic 480 overview, which outlines Disney's capital structure, contents, addresses challenges in debt and equity classification, and highlights key regulatory changes under ASU June 2020 to establish an analytical foundation. Second, deferred tax analysis. Examining deferred tax trends from fiscal year 2024 through the second quarter of fiscal year 2026 and assessing the impact of recent tax reforms. And finally, the impact assessment and conclusion. Evaluating the effects of new regulation on financial statements and earnings per share while summarizing Disney's strategic approach to capital management. So next, we move on to the first section. In this part, we will first clarify the regulatory requirements of FAST ASC topic 480, then examine Disney's current capital structure to identify the practical challenges in distinguishing between liabilities and equity, thereby laying the groundwork for analyzing the impacts of new regulations. As of September 27th September 2025, Disney's total liability amount to, I think, the $82.9 billion, including $34.16 billion in current liabilities and $48.74 billion in long-term debt. Its total equity stood at $114.61 billion. The overall capital structure exhibits a high leverage ratio, with $4.7 billion attributable to monetary interest, making it significantly more complex than that of average company. And the complexity of this capital structure stem from decades of strategic acquisitions and joint ventures. The acquisition of 21st Century Fox introduced substantial long-term debt. Ongoing capital expenditure in theme park experience division further increased liabilities. And multiple joint ventures, including Disneyland Paris and Hong Kong Disneyland, generated $4.7 billion in non-controlling equity interest. Note 14 of Disney's annual reports discloses a wide range of capitals of special financial instruments with constructional provisions, including mandatory repurchase option and variable share settlement agreement and some redemption costs. And this hybrid instrument that lie between liabilities and equity perfectly align with the application scenarios of the liability equity classification standards, and constituting the central focus of this analysis regarding the impacts of ASU June 2020. And in this page, you can see the formation counting items are related to FAST ASU June 2020, which introduced a systematic simplification of the accounting treatment for convertible instruments with 4 key adjustments in total. The first change eliminated the distinction between cash conversions and beneficial conversions fixtures, removing the requirements to split convertible instruments into separate debt and equity components. This directly simplifies accounting procedures and reduces valuation complexity. And the second, unified classification rules is implemented. Convertible bonds and convertible preferred share are collectively classified as either the liabilities or equity, and separation is required only when embed derivative meets ASC 815's requirements, thereby enhancing clarity in balance sheet presentation. The third addition introduced an exception clauses for the scope of derivatives. Independent instruments with downward adjustment clauses or specific settlement terms may be directly classified as the equity instruments, thereby expanding the applicability of equity classification. The fourth requirement mandates the uniform use of assumption conversion method for dilute earning per share, eliminating opportunity of companies to circumvent disclosure obligations through hypothetical cash settlements. This ultimately enhanced the transparency of earning per share disclosure while also increasing the reported level of dilution. The FASB ASU 2020, June 2020 fundamentally restructured the classification framework for hybrid financial instruments, establishing a systematic foundation for analyzing business financial statement adjustment. And we have now reviewed the key requirements of FASB ASC 480 and the challenges in classifying liabilities and equity arising from Disney's complex capital structure. Next, we examine deferred taxes, how Disney's deferred tax items changed between 2024 and 2026 under the combined impact of regulatory changes and tax reforms, and how these changes will affect its final financial statement. And now you can see the bar chart illustrates the trends of Disney's deferred tax liability over recent years. From fiscal year 2024 to fiscal year 2025, net deferred tax liability are cut in half, falling from $5.622 billion to $2.795 billion, primarily driven by a significant reduction in depreciation related to the deferred tax liability, which decreased from $6.584 billion to $3.998 billion. From fiscal year 2025 through the second quarter of fiscal year 2026, this trend reversed as net deferred tax liabilities rebounded to $5.05 billion, with the root cause attributes to One Big Beautiful Bill Act enacted in July 2025. The act was accurately depreciation incentive widened the temporary gap between the asset's book value and tax basis, and increased the current tax deduction, and thereby elevates future potential tax liabilities. Such fluctuations are by no means the result of isolated internal accounting adjustments. They clearly demonstrate that corporate financial data are influenced simultaneously by both internal assets depreciation rates, and external tax policies, with policy shift directly revising the directions of deferred tax changes. The above content outlines the regulatory requirements of FAS ASC Topic 480 and analysis Disney's trends in deferred tax liability over the past 3 years, thereby clarifying both the regulatory contents and the company's current tax landscape. Next, we examine the particle impacts of ASU June 2020 on Disney, identifying how the standard updates will affect its financial statements and future capital operations. I have identified 3 direct impacts of the ASU, the ASU June 2020 rules updates on Disney's financial reporting, while highlighting the trade-off between these regulatory changes. First, the new regulations eliminates the requirement to split hybrid financial instruments, those originally subject to periodic fair value adjustments can now be directly classified as equity assets. This not only reduce the valuations burdens on Disney's finance teams, but also minimize unnecessary profit fluctuation, enabling investors to more clearly assess the true profitability of Disney's core business. Secondly, the eligible instrument directly optimize the balance sheet structure after being reclassified from liability to equity. Disney's current holds $40.5 billion in long-term debt. Even a modest reclassification can be effectively reduce the debt-to-assets ratio, improving the debt-to-equity ratio, and enhance the key capital structure matrix of markets concern. And finally, the new regulations mandates that all convertible securities use assumed conversion method to calculate diluted earnings per share and require Disney to provide more transparent on balance sheets disclosures regarding the dilution effects of equity linkage agreement. This will directly increase reported dilution levels, compelling Disney to disclose transparency on true costs of its complex financing structures to investors. And overall, the rule adjustments represents a reform with both advantages and disadvantages. While simplified classification enhances reports presentation clarity and reduce accounting burdens, stricter disclosure requirements eliminate opportunity from companies to conceal financing costs. And the core value of this fast rule revision lies on eliminating the artificial segmentation issue arising from 2 separate models previously used in convertible bonds accounting. The original rules required mandatory separation of liability and equity components, which not only increased compliance costs for corporate valuation but also tended to obscure a company's true profitability. By simplifying the classification logic, the new rules directly reduce financial processing complexity, enabling users of financial statements to more clearly assess a company's actual operating performance. The new rules also mandate that more instruments with both debt and equity characteristics be classified as equity instruments, directly optimizing the Disney's balance sheet structure by improving the debt-to-equity ratio and reducing earnings distortions caused by fair value fluctuation. However, This revision also requires companies to use a unified assumption conversion method to, calculating the dilute earnings per share and mandates the disclosures of actual dilution effects, which is a necessary trade-off inherent in the regulatory framework. For business, this regulatory adjustment serves as a wake-up call when designing equity-linked instruments with repurchase clauses or establishing joint venture structures in the future. Companies must exercise greater caution in structuring these arrangements. The new disclosure requirements will directly reveal the true cost of complex capital structures, compelling firms to optimize their capital management strategy. And here is the reference list and the appendix. Thank you for your listening.